if you make friends with inflation, automatically you become rich, because he is the only friend of yours who can make you rich. If inflation is not there, you cannot grow rich. To grow rich, you need inflation. And let me explain to you how it works. So this is today's topic, which you have to understand, and you have to make friends with it if you want to grow rich. So now, what is the basic definition of inflation? Inflation is, like how we say in our common man's word, is basically increase in prices of the basic commodities which we have. And in the financial world, we say the decreasing value of the rupee. So when the rupee value starts decreasing, automatically that is how the inflation causes are there. So basically, inflation is more of rise in prices. Now, what actually causes this inflation, and what are the causes which you cannot avoid? And because of that, you cannot avoid inflation. And the main thing is, and I should say, we are very, very lucky to be in India, because these factors are really affecting inflation. One thing is, there is increase in public spending, which is caused due to the rise of standard of living. The standard of living now is not only like what we used to say, roti, kapda, makan, just the basic thing. Now we want luxuries. We want branded stuff. We always try to buy something which is now of the offer, because now also spending has become very easy, because now you get 0% loans, everything is available on the spot. So there's a lot of competition. But this inflation due to increased public spending is definitely going to create a big boost for the investors as compared to the ones who are just spending. There is another very important factor which is affecting India, especially. In India, we import more than what we export, because our population is so huge that we cannot produce for our own country. Whereas on the other side, if you see the other countries, they can produce, but they don't have consumers. And the only place where they can actually export their goods is basically in India, because in India, we have a lot of consumers. So the more the consumers, the more the spending. And what happens is, the biggest factor for inflation in India is, the basic factor is oil prices, because the import of crude oil that India does is actually the highest. So whenever we import so much of crude oil, and with all the taxes and all that the government charges, automatically inflation has to go up. Like say, for example, even now during this COVID virus, during this pandemic which had come up, during this pandemic, actually oil prices had dropped down to almost around $30 per barrel. But the petrol and diesel prices in India instead went up instead of going down. Why? Because the government started increasing the taxes, and it started collecting more tax from the oil companies. So in that way, the oil prices also went up. And now, because the oil prices go up, automatically all the other prices go up. And that is what is causing this inflation. Then the next factor which is also causing inflation is imposition of direct taxes. And now another, that is like GST, what we have started implementing, and also the indirect taxes which are there. So all these tax structures which are there automatically make your prices go up. And definitely the biggest thing is the increasing dollar valuation, because the prices of dollar also is going up. So as the price of dollar goes up, automatically the prices in India also start increasing. And the biggest factor, as I told you, is demand versus supply. The higher the demand, the higher the prices go. And the lower the supply, again the prices go up. And in India, the case is like this. The demand is very high, the supply is less. So because the supply is less, automatically prices have to rise up. So you cannot escape inflation in India. So now, if you take into consideration as far as inflation rate is concerned, I've compiled the figures from Google as far as the last 40 years is concerned. If you can see the figures here, in 1980, the inflation rate was 11% and RBI interest rate was 14% in 1980. In 1990, the inflation rate came down to 8.9%. and RBI brought down its interest rate to 8.10%. This is the RBI repo rate, in the sense the what rate the RBI gives it to the banks. So this is now 8.10%. Then in the year 2000, exactly 10 years from that day, if you see the inflation rate has come down, it's under control, it's at 4%. So automatically even the interest rates in India came down to 6.24%. In 2010, inflation again went up to 12%. Whereas this side, the interest rate came down to 4.40%. And now in 2020, inflation rate is 4.54. And this is now currently the RBI interest rate is 4%. So with this, if you notice, every 10 years, the interest rate and the inflation is coming under control. And what I can predict and what I can say is, the RBI interest rate is going to still fall down further now after this moratorium period is over, because there is a lot of liquidity crunch now as far as companies are concerned. Many companies will not be able to even pay back the loans and the installments, the EMIs. So because of that, there's going to be a liquidity crunch. And because of that, RBI is going to bring down the interest rate still further. So as the interest rate falls, keeping money in the bank, keeping money in the post office, your money will not grow at all above inflation. When inflation itself is 4.5 and interest rate in the saving bank is 3% and fixed deposit is 5%, you will not be able to actually beat inflation as far as the RBI rate is concerned. But on top of that, if you see the consumer price index, or the CPI as it is commonly called, which measures the retail inflation, because that is like the consumer inflation as far as the items are concerned, what we have noticed is that the prices of all the items keep on doubling every 8 to 10 years. So with this, inflation is coming to almost around 7 to 8%, because 7 to 8% shows that your money, actually, the cost of living increases almost every 10 years, it doubles. So with that, if you see the cost level, when we check the family spending, what I've noticed is this is the spending of the families in Goa, I should say. An average family with 4 members in the year 1990, at that time, the average spending used to be 5,000 per month. Exactly 10 years down the line, it has doubled to 20,000 per month. If you see in 2010, it has again doubled to 20,000 per month. And now this time in 2020, because of this crisis and all this thing, it has remained at an average of 30,000 per month. But this can also start increasing slowly. And I'm 100% sure by 2025, this will hit around 40,000 per month. So if you're not able to generate this income to take care of your family expenses, and that too, if you're generating it only from your salary, you'll have to work throughout your life. But if you're able to generate this income from your investments, and you are able to take care of your family expenses, only then you will become financially free. And once you become financially free, automatically your financial stress reduces and you tend to live longer because you have more peace of mind. So this is the way in Goa, the prices, and all over India, the same figures can be used, but this I've taken because I know the families here. So this is the average spending what we have, and you can take these figures as all over India. There is not a big difference in that. So now, what is the most important thing that you have to calculate when you see this inflation? The real rate of returns. Now, what is this definition of real rate of returns, which we are taught only in the financial classes? Otherwise, normally we don't know about this, but this is the actual thing what we learn. Actual returns minus inflation minus taxes, which means, I'll just give you an example. You park your money in an instrument that say gives you 6% returns, and you take the current inflation rate as 4.5% and a tax rate of 10%, which is like what we call a TDS. If you check the actual returns, 6% minus 4.5% minus 10% on it is almost like nil returns, which means your money, even though you're generating 6% returns, with inflation, it actually becomes nil returns. So if you want your money to really grow, you have to put it in places wherein they will beat inflation. If you put in places in instruments where the rate of returns doesn't beat inflation, actually speaking, it is deflation, in the sense you're making losses. And over a period of 1 year, you will not feel it much. But over a period of 5 years, you'll get a shock. Because in 5 years' time, if you have kept the money there, automatically there will not be value for that money, because the price will always be double, but your money will not even be more than 1.5 times that amount. So that is the cause of what deflation creates. So if you park your money in places where your returns don't beat inflation, it is actually making a loss. So then what we saw is, which are the places where the rich people park their money normally? So there are only 4 asset classes which I have noticed where they put it in. Some of them put it into real estate. Some of them invest into gold ETFs and physical gold. Some invest into currencies and commodities. And many of them, majority now, have started investing into equity and businesses. Businesses and equity is one and the same word. The only thing is, in the businesses, if you run it on your own, it becomes your business. When you share with someone else, it becomes equity business. In the sense, you're becoming an equal partner with the other businesses and holding the shares of those companies. Now, if I take each sector separately, if you will consider now real estate. Real estate is actually meant for only people who have enough of money to park their money in that. Because real estate, you cannot do with small amounts like say 1,000 rupees or this. You have to invest in lakhs of rupees in order to go into real estate. And the worst part about real estate now is, with the introduction of this RERA as well as the REITs, all transactions which are done as far as real estate are legible, in the sense you have to be doing it on paper and pay a stamp duty on it. So the higher the price, the higher the taxes. And the best part or the worst part of what this real estate is, liquidity is very difficult. In the sense, once you buy, to sell it, you have to sell it either fully, or you cannot do it by part, and you have to get a sale whenever you require. But when you block in a huge amount of money into real estate, it becomes very difficult as far as liquidity is concerned. And as far as tax benefits, there are no tax benefits on this. You have to pay short-term and long-term capital gains, because short-term capital gains is 20%, whereas long-term capital gains is 10% on whatever appreciation you do. But that again becomes trading. Buying and selling is trading. But if you are generating returns on it, like you are generating a rental income from it, the returns on investments on the flat or a house will not even cross more than 3%. Because what we have noticed here in Goa, even in Mumbai, the maximum returns you get on an investment in the flat is 4%. Let me just give you an example. Suppose by chance you have invested 50 lakhs into a flat. The maximum rent that you will be able to generate from this will be somewhere around 15 to highest can be around 20,000 rupees. But on an average, 15,000. So 15,000 you multiply by 12 is 1,80,000. 1,80,000 on 15 lakhs invested. The returns is not even 3 to 4%. And the best or the worst thing I should say again is, this rental income is again added to your taxable income. So automatically you end up paying more tax. So this is as far as real estate is concerned. Now, as far as gold is concerned, if you buy physical gold and keep it for yourself due to some emotional attachment, like you keep it in the locker or you make ornaments out of it, that will not give you any returns unless and until you sell it. But selling physical gold is the last option that all of us have. Now, as far as gold ETFs, or what we call it as gold shares, is concerned, this is paper gold actually in the form of shares. These at least will give you some returns. And now there is something what we call it as sovereign gold bonds, which have come out with the RBI has issued. Even now, recently it's on sale, wherein you can invest and block your money at the currently the price per gold is approximately around 42,000 rupees per gram for 8 grams. That is per gram. And on that, your lock-in period is usually 8 years. So what this sovereign gold bond does is, it gives you a guaranteed interest rate of 2.5% per year, which is paid to you half yearly. And at the end of 8 years, whatever is the appreciated price of the gold after 8 years, that will be the value which you'll be getting. So basically, it's like a gold ETFs which can be invested into it, and it gives capital appreciation. So that is the difference between physical and gold ETFs. But here, the lock-in period is minimum 8 years. If you try and remove it before that, then there'll be an exit load on it. Now, currencies and commodities, yes, here also you can make quite a lot of money, but this is basically trading. You have to buy and sell. Like I can just imagine if about 5 years back, we had to buy, say, around 1,000 US dollars. Today, you would have made double the money within 5 years, because the dollar prices keep going up and currencies are always going up, especially for Indians. Standard of living is getting expensive more because of the dollar prices going up. And why this dollar prices go up is because, as I told you, our imports is more than our exports. So automatically the prices go up. And finally, the best place where I feel is the best to invest is in equity and businesses. Why? Because this is the only asset class which will always try and beat inflation. And here is the one where you make maximum profits. Because any business in India, you start any business, you have to generate at least 15 to 20% returns. The only thing about businesses is that it is non-guaranteed. So non-guaranteed means one day it might give you profits, one day it might give you losses. But if you check over a period of 5 to 10 years, it is definitely businesses only which have made people rich. But if you look at it, a trading aspect of it, like buying, selling, you might get short-term gains, you might get short-term returns, but it will not give you lifelong returns. So if you invest into businesses in India, this is the only asset class which has the potential to grow high, only because one thing is interest rates are coming down. So automatically the inflow is more, spending is more. So definitely the profits also start increasing. And second thing is, the best what I like about this is the flexibility. You can invest how much you want whenever you want. And if in case you don't have the time and knowledge about the investments, the best source is the mutual funds, which are basically like agencies which invest on your behalf after doing research. So equity and businesses, among all this, is the one which is the only place where you can actually beat inflation and not take much of a risk. The risk can be minimized as far as the equity is concerned as compared to real estate, gold, as well as currencies. So now what happens is, if you check from all these four parameters, that is, as far as returns are concerned, as far as liquidity is concerned, as far as tax benefit is concerned, as far as the risk is concerned, there is no other place better than equity, or what we call it as businesses, to invest your money and make your money grow. And what we have found is, if you see the Sensex graph, right from the time 1990, if you take it right up till, say, today's level, that is, this is now the Sensex graph which I've taken, right up till, say, the 28th of July. That was just about 2 days. That means as on Friday, the 28th of July, this is how we have taken the Sensex graph. What we have thought is, if you see this graph, there is a general rise in the market prices. Only thing, it goes up, down, and every time it comes down, it recovers back very fast. And this is how the correction is. And this time, because of coronavirus, we had predicted that this would be a U-shaped recovery. But go to see, because of the Indian economy, it has become a sharp V-shaped recovery. In the sense, within 2 months, it has almost recovered 80% of whatever fall has done. When the coronavirus thing hit in the month of March, Sensex had actually come down from 42,000 to 27,000. And today it has recovered back to 38,000. So now you can imagine the recovery has been so fast. We were saying that it will take time. It will come up only in 2021 after the vaccine comes, after whatever the issue that corona gets cured and all these things we were saying. But go to see, even before that itself, the market has recovered already and it's still recovering. Now there is a prediction that there might be another bubble burst because it has recovered quite fast. But whenever it falls, it is best an opportunity. This is the best opportunity. And let me tell you, in the last 3 months, whoever has invested in equity markets has made more than 20 to 30% returns within the last 3 months itself. And whoever has continued his SIP has definitely brought down the average buying price. So the recovery has been much faster. So whenever this market falls, these are basically opportunities which you have for growing the thing. So now what happens if you see the Sensex thing? If you try to invest into equity, there are two ways you can do it. One is either you invest into direct shares, and investing, remember again, I'm saying investing is basically getting married, whereas trading is dating, in the sense keeping on changing. So now if you want to go into shares, first thing is you decide which company you would like to invest in. And once you decide to get invested into that company, automatically you need to stay with that company and invest for at least 10 to 15 years. You have to be with that company for 15 years. And let me tell you, each and every company will share their profits with you, provided you remain with this company. And the more the number of shares, the higher is the dividends. So you have to invest big amounts in order to get into the share market. But the major risk in this is you are putting it into one company instead of diversifying into 40, 50 companies. But the problem is, if you diversify into 40, 50 companies, then you'll have to do trading and you'll have to start matching and seeing which fund is doing, which one is not doing. And when you have too many funds or too many companies' shares, automatically your profits start decreasing. So shares is good for people who can invest a big amount of money and stay invested with them for years. So automatically it's a higher risk. You need to time the market. You need to do a research on it. And definitely you need to put in bigger amounts. But to take care of all this, we have the mutual funds, which is actually meant more for beginners, with people who are actually new to the market and who are not able to put in a huge amount and who are not financially free. So first, in order to achieve financial independence, you need to start going in through mutual funds. Because if you try to go in through shares, it's like you try to do things fast, but you lose also money fast. But once you're financially free, you can go into shares and you can put in bigger amounts of money, and then your money will grow much faster. But before going into shares, first ensure that you have a passive income through your mutual funds. And mutual funds gives you the advantage of professional management, because there are fund managers who have done research and they know all the formulas on how to calculate the risks. They invest into stocks on your behalf, and it is not put in one stock, but it's put in a group of companies. So the risk is minimized, and they keep a watch over it 24/7. In fact, when I've been in the fund managers, it's basically like a doctor's job. They check the ECG of the patient every time. If the ECG goes into a straight line, then only the company is shown as dead. But when the ECG comes down, the company, they pump in more money. And when the pressure goes up, that is the time when they liquidate and make book profits. So actually the job of a fund manager is basically to monitor the companies, and they have almost like a medical doctor's team analyzing each stock separately. So for us who are into other businesses, other professionals, we are basically handing over this money to the professionals, and with the professional, by paying a fee of 1.8% or maximum 2%, that fee is used for getting the expertise done. So that is the professional management which is there. Secondly, it is diversified. There, the biggest option which you have in mutual funds is you can choose as per your risk appetite. There are debt funds, there are hybrid funds, and there are equity funds. So you can choose as per your risk appetite. If you want to keep it for short term, you have debt funds which are very good, but debt funds are very bad for long term. If your horizon is long term, equity is very good, debt is very bad. So based upon your horizon, based upon your risk appetite, you have to select which fund is the ideal one for you. And if you remain invested in that fund, whether it is a multi-cap fund, large cap fund, small cap or mid cap, or even a focus fund, it doesn't matter. But what matters is how long you have been with that fund. The longer you are with that fund, the more will be the profits, because the NAV increases with inflation, and your number of units accumulated multiplied by the growth in the NAV will actually give you profits. And actually profit is calculated as your average NAV minus today's NAV into number of units. So if the average NAV is lower than today's NAV, then automatically it is profit. But if today's NAV is below your average, then it is loss. But that is only if you sell. But if you buy it, it is basically profit. And now in the last 3 months, in most of the funds, the average NAV means the current NAV went below the average, when we call it as a red phase. And the moment your NAV goes above your average, it's called as a green phase. And red phase is actually the best time to invest into equity. So now just give me some time. I'll just share with you one extra slide. I'll just 1 second. Just give me 1 minute. I'll share you some slides now with this as far as mutual funds are concerned. And here I want to share with you an SIP done of a fund which was actually the worst performing fund. Now, consider this one worst performing. It's an IT sector fund which was started in the year 2000. In February 2000, it was an NFO, and one person started an SIP of 10,000 per month. So in the month of February, at the NAV of 10, he got 1,000 units. In the month of March, he got this. 1 second, just so I think cannot see the screen. One minute, I'll just try and share it again. Yeah, can you see the screen now? Yes. Okay, so now IT this IT fund which was done by ICI, this is just a sample. I'm not asking you to do anything in it. This is just a sample what I've taken, just to show you how red moments will actually benefit you in the long run. Now, this fund, when it was started in February 2020, the NAV was 10, and within 2 months, it started going down. This was actually in 2020 when the IT bubble and US attack happened. So if you see this, from 8.74, it started going to 6.15, but the number of units started increasing here. Then 5.68, the number of units increased, and the amount invested is the same. So during this red movement, this is the time when actually the NAV had fallen down and it had touched almost 2.08. But the same person remained invested, accumulated quite a lot of units when it was down, and then slowly it started recovering. But this was all the red moments when the NAV was still below the average. After that, the market recovered slightly. It started recovering in 2002, and the NAV started increasing from 3. It went again to 2, then it went to 4. And if I see this full white area, this area is when the NAV kept on increasing. It went on even to touch 10, then 12, 15, 16. This is the entire area where it was in green, and it reached the peak of 14 rupees NAV. That was exactly in the middle of 2008. And exactly after this, the subprime crisis started. And again, it started going down. From 14, it went to 13. then it went to 11, then it went to 9, it went to 6, then it started recovering here, but this is still the red moment. But one thing we have noticed here now, the red moments here is just limited to somewhere around 12 to 13 months, whereas the first one was almost 2 years. Now it has come down to 13 months. Then again, it started climbing up. The person continued and it reached its peak of 20 in 2011. In February 2011, again the coal scam came and the 2G scam. And with that, again, there was a red moment here, wherein again the NAVs dropped and he collected more number of units here, because this was the time when the markets had fallen. But now see the correction is much faster now. Now it's come to only about 7 or 8 months. Then again, it's gone in white. Again, it started going up. Now the NAV started picking up. It reached 40. From 40, then it started going up and down here. Then it reached 50. Then it touched 60. And it touched the exact peak in the month of February 2020. Before the coronavirus started, the NAV was 60. Now, the moment coronavirus attack came, the NAV dropped down again to 57, 44, and then it went up to 49. And in the month of June, this NAV touched 52. Now, if you see the total amount he invested is 24,50,000. And if you see the value now, I'll just show you the calculation on this fund. The total amount invested is 24,50,000 because he has put in for almost that 245 months. Amount invested per month was 10,000. The total number of units he accumulated is 2,57,445 units. And his current value as on 30th of June was 1,42,62,505, which gave a CAGR of 15.08%. Now, this fund was actually classified as one of the worst performing funds. But if you check and see, someone who remained invested with it, even with the worst performing fund, has got 15% return, which is now almost not only 2.5 times more than what PPF will give you. And what I've learned in this is, during the crisis period, he bought exactly around 1,11,986 units, and the amount invested was 5,70,000. And these units have converted into almost 59 lakhs of rupees, which has given 10 times growth. In the sense, 5,70,000 becoming 59 lakhs is 10.36 times the growth. And during the normal period, during the white period, when the thing was above the NAV, he accumulated 1,45,000 units. He has invested 18,800. Means 18 lakhs 80,000 rupees, and the value of those units is 76 lakhs 73, which has grown by 4.08%. Now you can see during the crisis how much it has grown, and then the total the times that it has grown in the last 20 years is 5.54 times, which means it has doubled 5 times as compared to what he has put. He has put in 24 lakhs, and 24 lakhs has become 1.42 crores. And this is the power of equity. Now, this is the worst performing fund. Now, let me share with you another fund, which is also a good performing fund, which we consider as one of the good performing funds. So I'll just share that screen now, new screen. Now, let's take this case and see, this is one of the best performing fund. This comes under the best performing, which is like what we call it as Nippon India Growth Fund. Previously, it was called Reliance Growth Fund. Now, someone who has started investing 10,000 rupees a month from March 2020, at that time, the NAV was 43.64 rupees. So the number of units were 229. Then here there was a slight correction, the correction which was going on, and he kept on accumulating more and more units. Then suddenly, exactly that same IT bubble burst, the NAV dropped down to 24 and his average started coming down. So this is the time, and it was like in the red moment. One second. So this is the time when it was in red moment. And then you can imagine in 2016, again, it started growing. NAV was 800 rupees. So the number of units is less. But then this red moment was not much. But then again, it started growing up. The NAV from that initially we had started, the NAV was somewhere around 400 when we started. And then exactly in 2015, it had touched 800. Then again, there was a correction here because of the federal rate cut which was done in the US, because that time US was controlling more of Indian economy because a lot of money is to come from the foreigners as compared to Indians. So that time we were more dependent on them. So at that time this correction started, and then in 2016 again it started going up. It touched almost 1,100 the NAV. Then after that, it had touched its peak at exactly in February 2020. The NAV touched 1,230, and the number of units he got at that time was 8.13. Now, exactly after the coronavirus scheme came, from 1,230, you can imagine the NAV dropped to 874 rupees. And whoever has invested at this moment and continued even with the SIP, if you watch and see, it recovers quite fast. And now the thing is here, this client has accumulated total 23,279 units, and investment amount is 24 lakhs 40,000. SIP was done of 10,000 for 242 months. SIP date was 10th of every month. Total units accumulated is 23,279. And the total value of this fund is 2.26 crores of rupees. So imagine 24 lakhs becoming 2.26 crores. And what we have seen again in this analysis, which part of the time is the time when the maximum returns come, is actually during this crisis period. When the red moments were there, he accumulated 9,116 units. The total amount invested was just 5,60,000, but that amount has become 88 lakhs of rupees, which is 15.83 times the growth. Whereas during the normal period, that is during the green time, he accumulated 14,164 units. Total amount invested is 18 lakhs, and the value is today 1.37 crores, which has grown by 7.33 times. But if you see the difference, it is actually this red moments which actually give you more returns as compared to the green moments. And overall, yes, 9.28% CAGR, means 9.28% is the type of growth that it grows. But if you see the returns, it is 19.01. Now, you consider inflation of, say, the same 5% or 6%. Only this can beat inflation. And only when you start investing like this and beating inflation, only then will you be able to get returns. So if you start doing this, then only the things will start working. Otherwise, it will not help you in that thing. Means you will not be able to make profits if you don't start investing. And the benefit of this is staying invested for long. So when you stay invested for long, even SIPs, basically my definition of SIP is sleep in peace. No need of timing the market. You just keep on accumulating units without feeling the pinch, as compared to timing the market and then accordingly doing that. But if by chance you get any red moments, let me tell you from my analysis what I've seen, these red moments come only in the first 4 years that you start investing. If you remain with the fund for more than 4 years, it is very, very difficult for you to get these red moments after that. And red moments basically are when the NAV goes below your average. And whenever it goes below your average, if you get those chances, those are the best moments for you to make double the returns. So you take this crisis as an opportunity, and then only you become successful. But if you take this crisis as a penance, or you say that it's a crisis, means you panic on that, then you lose the opportunity, and then you start investing again when the market goes up. And when market recovers, you have to have that you'll be buying the units at a much more expensive price. So this was the best time to invest during the crisis. And we always wait that the prices fall. But if you remain in an SIP, you will always get, as per the law of averaging, you will always get anybody who has remained invested. We have a data also. Anybody who has done an SIP for 10 years has never made less than 16% returns. Even the worst performing funds will give you 16% returns over a period of 10 years. Now, if you take the best performing funds, on an average, 24 to 25% returns can easily achieve in the best performing funds. But the main thing is you need to be invested for long and don't do trading. Invest means remain invested for long. So if you accumulate units over a period of 10 years, I can give you guarantee. There is nobody in this, in India especially, who has invested for 10 years and said that equity market is not good. Who has said that equity market is not good are the ones who have been there for 1 year, 2 years, or 3 years. People who have invested for 3 years, the first 3 years are the ones who actually keep on changing the funds and trading and trying to book profits and keeping on changing the funds. But if a person has remained with the fund for more than 5 years, it is very, very difficult for that person to give up that fund. He's almost like in touch, because that fund will always give you better returns than the fund which you have been there for 1 year, 2 years. So the longer you remain with the fund, the more of the profits you make with the power of compounding. And the compounding effect is terrific. And I'll tell you, if you make use of it, you'll definitely grow rich very fast. So accumulate maximum units at a lower prices and then you can even take some time. If you want, you can stop even after 5 years or 10 years, and then leave it there for 5 years. With inflation itself, your NAV will grow up and your profits will increase based upon the number of units that you accumulate. So that is how this mutual fund works. So the only way to actually grow rich, I'll stop the sharing of this screen. I'll come back to the normal screen. So the only way that you can actually grow rich is basically investing in equity. So now that I've already shown you, if you want to actually start investing, we are there to help you out as far as fund selection is concerned. If you want to go into direct shares, the first thing is it's not that I won't encourage you to go into direct shares, but direct shares is good only for those who are financially free, who are ready to take higher risks, and who are able to time the market and remain with and bear the falls and all which is there. Like I'll tell you, in my case also, in the first 10 years, I was totally into mutual funds. Now, after I became financially free, I have started going into shares, and I know that through shares also you can make a lot of money. But for that, you need to put in also a lot of money. So unless and until you're financially free, stick to mutual funds, and shares you can go after you achieve financial freedom. And definitely that will give you much more money later on. But if you try to go into shares with very little money by just putting small amounts, your earning per share will be very, very less. And especially if you go into blue chip companies, the share prices are very expensive. And imagine having just 10 shares of, say, like a company like Maruti. Your earning per share will not even be more than 7 to 8 rupees, or even say 10 rupees, the maximum. So your earning per share becomes very less. But if you can put in lakhs of rupees and buy 1,000, 2,000 shares, then only it will make a difference. But for that, you need to be first financially free. Otherwise, it's going to be a very big risk in your life. As far as taking risk with money, you have to be very careful. So the best option for beginners and especially for students is basically mutual funds. And later on, after becoming financially free, you can go in for shares. I'm not saying that bad. Shares are also very good. So with this, I actually finished this one slide. And now I'll just give you a small introduction to the next speaker whom we are going to be having now on the month of August. We have a program which is Be a Shining Star. This is basically for college students. As far as financial literacy, we have already done 2 sessions. Previously, we had UDAN program, which was a 3-session program on how to lift your performance and how to improve your performance and uplift your self-esteem. Now, in the month of August, this program, if you attend all the 4 sessions, there are 4 sessions, which is exactly an acronym of STAR. So the first session is going to be on S, which is called Setting Smart Goals. So goal setting will be taken care of in the first session, which is going to be on the next Wednesday, that is 5th of August at 7 p.m. And like this, for the 4 Wednesdays, we will be having this entire STAR program, which is totally sponsored by Nippon India Mutual Fund. So the month of August, all those who want to actually achieve success in life have to attend this program, the entire 4 sessions. That is STAR program. So the title of this program is Be a Shining Star. So if you want to actually achieve success in life, these 4 sessions will definitely help you. And in addition to that, there is another very, very important program which we are going to do on 15th of August. That is our Financial Independence Day, wherein we have just confirmed that Hitesh Mali will be our guest speaker for that day. And that program is going to be a terrific program because Hitesh Mali has been with us 2 times in Goa. And whoever has attended his sessions are definitely going to love it. So he is going to be there on 15th August, but that is a separate program as compared to the Shining Star. Shining Star is for you to develop yourself into a successful person. So there will be 4 sessions on every Wednesday. So I would request maximum students and parents as well as teachers to take the benefit of these free learning programs. So if you can join us for the programs, it will be very good. But in case by chance you have missed it, these programs are uploaded on our YouTube channel, Navemar Foundation Live. So you can click on the Navemar Foundation Live YouTube channel, subscribe for it, and at the same time, you can click on that bell icon and you can get a notification of all the programs which are happening. And the best part of it is all the programs which were held before are uploaded on it. You can watch each program whatever on any day you want. You can select which title you want. They are all uploaded in the library on YouTube. And I'm very happy that many of y'all have actually started watching. So much so that last week's program, what we did on the 5 golden rules, we had more than 600 viewers on that, which means people have started watching on YouTube again. So today's program also will be uploaded very soon. And it is there now, the recording is going, but then we will upload the session and then you'll be able to actually see it again. If you want any clarifications, you can always be in touch with me through WhatsApp. My number will be there on the YouTube channel. You can see it. And if you have any suggestions, any difficulties, always be in touch on the email ID. Either you can email it on navemarfoundation@gmail.com or on navemark@gmail.com. Both the email IDs are available. You can put up your queries, and I would suggest try and get more friends of yours to actually try and attend these programs, because this will be definitely of benefit to all. So I would like to end the session by saying a very, very big thank you for all of y'all who have attended it today. There are many people on YouTube, and on our Zoom channel, we had a total of 90 participants. Plus, on the YouTube channel, many are there live. So you can put in your comments, and share your comments even on our YouTube channel if you liked it. And even here on the chat box, you can share it. There's no harm in that. It will help us get motivated to do better next time. So see you all for the next webinar, which is going to be on the 5th of August at same time, that is 7 p.m. And I hope you have all enjoyed it. So I'll pray that you stay safe, stay home, and take care of yourselves. Good night. Thank you.